Good to see you as always.
Noel Herderich has seen the headlines.
There's obviously a certain amount of concern, and the natural reaction is, get out.
Visiting his financial planner, Herderich has an idea about what to do with his money, but admits it can all be a bit confusing.
I have a few crazy thoughts in my head that either Ron is going to say, yeah, they're good, or you're going nuts, and don't do it.
And he would be right.
It's important to know that these declines happen each and every year.
Financial planner Rona Birnenbaum points out downturns are normal, but that investors, many who don't follow the financial news, still feel the stress, but it could be a good thing.
People overestimate how comfortable they are with volatility. So the fact that they're seeing this now makes them think, I think, a little bit more honestly about what kind of an investor they are.
The more you see numbers, the more myopic you become.
Along with rising interest rates and inflation, there are a number of other factors at play. Algorithms and computer program trading can make swings more pronounced. So do emotions.
You've got two factors that drive how people make decisions, fear and greed. So you wake up in the morning, you see the market, holy mackerel, the market's down 1,000 points. Fear sets in, I better start selling. Oh, greed, I got a chance to buy.
That volatility visible on the market this week is something people here on Bay Street seem to be taking in stride.
I think if I was about to retire, I would be a lot more concerned about my investments, but I have probably another 30, 40 years.
Not everyone has that long to go, and smart investors who are older say they need to play it safe.
The lower risk is what I would have the appetite for rather than the high risk. So it doesn't really affect me much on a daily basis. It's just a knee-jerk.
A positive end to the day on the markets, but a gut check still for those making decisions about their own financial futures. Renee Filipponi, CBC News, Toronto.
Guarding your finances is always a good idea, especially since many experts do believe a market correction is in the cards before too long. That's when a market drops at least 10% over its one-year high. Now, Monday's drop didn't come close to that. Here's a brief look at how this latest slump compares to some of history's steepest plunges.
This is a huge cow patty with a piece of marshmallow stuck in the middle of it.
The 2008 financial crisis was long and painful for many, but the deepest single wound was on September 29. The Dow lost 7% of its value in one trading session. But that pales to October 19th, 1987, Black Monday. In a brutal shock, the Dow lost almost 23% of its value in one day, the worst single-day drop the stock markets have ever seen, an event that earned inevitable historical comparisons to the big one. October 28, 1929, kicked off 2 days of agony that would trigger a global depression. First, on Monday, the market dropped almost 13%. Then the next day, Black Tuesday, another 12%. A quarter of its value gone in just 48 hours.